Hello traders, Gary Wagner here, just about 1040 in Honolulu, 340 in New York. It is Tuesday, 9th day of February 2016, and this is the daily report for gold and silver. After trading to the upside for, I believe, 7 or 8 consecutive trading days, we do have the market correcting today, correcting about $8.30 when we look at COMEX, currently trading at 1189.80. It has traded to a low of 85.90, so we're just about $4 off the low. And in terms of the high today, 1199.30. That 1199.30, I believe, is critically important because we really want to see whether or not the market can take out 1200, whether 1200 remains resistance. That's where we're pegging strong resistance right now. And if that is the case, will that level of about 1180, 1175 hold in terms of current support? Now, that, as I said, that is looking at COMEX. When you look at spot, you'll see in essence it's unchanged on the day at 1189.53. Highs and lows are going to be about the same. It's simply the net change that will be different. So traders, first chart that I want to look at today, daily chart, standard candlestick format. Don't let the 1440 fool you. Our daily charts are not updating properly, so I've just converted this to a minute chart. On this, one fib retracement from the beginning of this rally, roughly at 1045, up to the most recent top, which is roughly at 1201. Then we have various different levels. Our 25, I'll change that to 23, of course, 38%. 50, and then of course 61% retracement. Now, the reason I actually bring that up is twofold. First of all, when we look at this particular price action since the beginning of the year, we can absolutely make a case for a handle right here and then our cup. So we definitely have a cup and handle pattern forming. One. Secondly, when we look at the most recent price action, this is the first time, as I said, we've had 7 consecutive days of higher pricing. This is the first time we've got a very, very small star gapped really near the close of the prior day candle. So that tells me that we could in fact see some sort of backfill or correction. I would still believe that we're in a bullish mode, but a correction after the kinds of moves that we have seen is really something that isn't out of the woods, so to speak. I would expect it. Now, that being said, what we want to then determine is, okay, so we have this market move basically from 45 to 1200. When we look at that, we calculate that, you can realize that we're looking at a price move of about 160 points. That's a pretty good rally because a typical strong gold rally is typically 100 to 130. So when you take, for example, 1070 up to 12, this would be your 130 here. And so we have had this market genuinely come in a series of waves and now hit this top. So it could be that we find some sort of resistance in that area. Now, first of all, that is one of the primary reasons, of course, that we actually moved our stop the other day. We're sitting long at 1117. Our stops are now below 1175, and that's this price point here because I really wanted it to be under these series of tops here so that if this market came down and found support, whether it finds support at roughly the 1080 area or 1075 area into this particular price area, we would still hold. If not, we're going to pull profits, and pretty exceptional profits for the first gold trade of the year. So traders, on the bull side of this particular set of logic points that we're looking at as to whether or not this market will begin to correct, I draw your attention to this daily Japanese average Heikin-Ashi charts that we have just put up. And because it is looking at the midpoint to midpoint, you can see that today's candle is it's still large. More importantly, it still has no lower wick. And so that what that tells me is even with this market resting in this area, we could see this market continue to move to higher ground. And so traders, lastly, I do want to revisit the chart that we've been looking at over this last month with an alternative wave count. Of course, the key distinction to this particular wave count is that it is looking at this grand top, which makes a lot of sense, but this grand top historical high, record high, as a conclusion to a major fifth wave. And the fact that that is a historical and record high really correlates well with the fact that it would be a major fifth. If that's the case, we are now have just completed, I also believe at this point, a major A wave. And when we consider that from 5 to A, we move down from 1900 down to about 1047. That's a pretty sizable retracement itself. And the way that we look at it at this point is that we're probably now just at the beginning of our B wave. Now, our B wave will typically go anywhere between 50 and 75% that of A. So my current target for the conclusion of our B wave is around 1450. However, I don't want you to get so excited or too excited too quickly, because we have to now add a time element to that. And to do that, or to give you an idea of what we're talking about, I've got another chart. It's a duplicate of the one that I just pulled up, but it has one additional study in there. And the additional study that I have added is a Fibonacci time element to it. Just like a Fibonacci retracement, you can also do that in time. And what I've done is I have marked a couple of points. Our beginning point, of course, is going to be this record top. And our concluding point, or as you can see, 1, is going to be the termination of our A wave. Now, when we do it, the first thing it will do, and this is just interesting to note, it will then begin to break it up. This is our 23% retracement, which lines up pretty well with wave 2. You've got a 38% retracement, which roughly lines up with 3, not exactly, but roughly. And then you've got your 61% retracement, and that roughly lines up with this intermediate 4. So you can see how that time element kind of fits in and actually gives us some valuable information. Now, when we do that, we can also extend this time element, which is exactly what I've done. Now, under one model, we would look for, in terms of a time element, we would basically look for the B wave itself could take as long as 61% of the amount of time that it took for this A wave. And if that's the case, it puts us pretty far out in time. And so that's why I'm saying don't get so excited, because this would take us roughly to August of 2018. So what that means, though, is that during this period, meaning 2016, 2017, and part of 2018, will basically be in an upward tact, and we'll look for a conclusion to be, as I said, somewhere around 1450, 1475. Also realize that what we'll see, though, is some sort of wave count that moves it up through this particular cycle. And so, although I am cautiously optimistic and I am looking for a pretty substantial price hike over time, realize the time element that I'm talking about is got to be a span of years and not months. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.